Hi, welcome to our very special event with two living legends, former drummers and athletes. The Bond King himself, Jeffrey Gundlach, along with Felix Zulauf, both legends who don't need a lot of introduction. So let's kind of just jump right into it. First, gentlemen, thank you both very much for your time right now. This is a critically important moment in the history of global economics and markets. We're going down a path that we have never been down before. I know you've seen a lot. Maybe you feel like you've seen it all, but certainly unprecedented amounts of central bank money printing, government interventions, and still, grappling with issues of debt, income inequality. And so this feels like it's the beginning of a grand experiment. And we're going to lean on both of you gentlemen very much to find out perhaps where we go from here. So let's begin there. Let's begin with these rising bond yields. Felix, I'll start with you. Bond yields are really beginning to spike here. The stock market's noticing a little bit. Obviously, people are getting a little antsy. PPI in the United States coming in a lot hotter than anticipated. This feels like it's the beginning of a major spike. Where are we headed with respect to these rates and inflation and everything else?
Well, my subscribers know that I wrote a piece about mid-year in 2020 that this is the sell of a generation for bonds. And I was calling for a upcycle in bond yields. And I think the upcycle is driven by unprecedented stimulation on monetary and fiscal side in the US and elsewhere. It's global in nature. And I think this will probably lead to a pop in the economy for maybe up to 3-4 quarters into next year. And this creates rising inflation because we have an important change in the inflation picture, which is the pricing of Asian exports. The Chinese corporations have been reducing export prices every year over the last 20 years, every year on average by about 1% or so. And now they are raising export prices. And on top of that, you have rising Asian currencies against the US dollar and also against the European currencies. And this creates a swing factor that will probably lead us to, let's say, at some point this year, 3% CPI inflation. And I think the bond market has not been prepared for that. And we have rising bond yields probably into next year. We are now coming towards the 140, 150 area, which is some resistance, and the rise may pause for a while, but the cyclical direction is definitely up. And I expect bond yields, the 10-year Treasury, to reach the 2% zone. Whether it's 190 or 220, I don't care at the present time, because what's important is the direction.
Jeffrey, the notion of 3 or 4 quarters of prosperity or growth in exchange for what could last into some sort of inflationary spiral seems like a small price. Maybe it's politically driven. Your thoughts on obviously yields are going higher, but your thoughts on where this is going and ultimately what it does cost us?
For many years, we've developed indicators at DoubleLine to try to give us a guidepost as to where maybe the 10-year Treasury yield should be based upon historical relationships. One of the best indicators is the ratio of the price of copper to the price of gold. There's a reason why that is a sensible thing for bond yields, because copper is economically sensitive and gold can often be kind of a risk-off sort of an asset. So more recently, for the last several months, if not quarters now, copper has been rallying, particularly since the summer of 2020, a lot, and gold is actually flat to down. So the ratio of copper to gold right now suggests that in a free market sort of situation, you should expect the 10-year Treasury right now to be at 2.25%. And of course, we're about 100 basis points lower than that, having come up somewhat from the very depressed levels of late last spring. Another indicator that is very helpful for the very long term is simply the 7-year moving average of nominal GDP, which has been a remarkably good long-term indicator for yields. That suggests the 10-year Treasury today should be at about 350. So we have tremendously suppressed bond yields thanks to the Federal Reserve. Foreigners aren't buying our bonds anymore. Treasuries have been for sale by foreigners for years, and it accelerated fairly dramatically, the selling in 2020. The public is not really interested in bond yields at these levels, which are below the inflation rate. And pension plans, it's almost not even worth putting them on the efficient frontier because their actuarial assumptions are so significant. Meanwhile, the Fed seems to be preparing us for the reality that we're going to be seeing. Our model shows that the number that's printed in June, just a few months from now, should have a 3 handle on it for the headline CPI. And we've had Fed governors like Charlie Evans, number 2 man at the Fed, say that he doesn't care if inflation goes above 2.5%. In fact, they're starting to welcome inflation being higher than any part of the Treasury yield curve. And you know, they say they don't ring a bell at a change, but I get the New York Times. I get it mostly for the puzzle. I do the Saturday and Friday crossword puzzle, but I do look at the headline. And yesterday's headline, literally yesterday, the headline on the front page is "Inflation Fears Fall by Wayside in the Biden Era." And then it just goes on to talk about the massive stimulus that we're going to do. And I find that very interesting that the mainstream media is now in cahoots with the Fed governors, really almost cheerleading for higher inflation, telling you don't worry about it. But inflation is obviously heading higher, and the stimulus is likely to keep, as Felix said, the economy running pretty well in the next few quarters. We just got the $600. That helped retail sales a lot. That was reported today. And we got maybe another $1,400 coming to a lot of Americans. We know that that goes into a propensity to consume. So it does seem quite likely that this massive deficit-oriented economic growth is going to continue. I like looking at the website debtclock.org, and it shows all these numbers spinning like a Tokyo taxi meter, and it talks about how the deficit is going up. But it raises a really good point. The government doesn't tell you the truth about a lot of things. One of the things they don't tell you the truth about is how much they spend. The government says they're spending, 6.6 trillion or something like this, but it's actually 8.1 trillion when you have the numbers that are off balance sheet. And 8.1 trillion, think about that. That's something like 40% of GDP is government spending. And we have 4.6 trillion of that is actually borrowed. So more than half of all of this massive government spending is now deficit based. And I think everybody knows that we're not going to pay that back. And so the game plan seems to me, not that clandestinely, is let's have negative real yields everywhere. The corporate bond market, mortgage rates are negative, treasury rates are all negative. That helps to slow down the cost, as you put it, Charles, of all of the stimulus, which will ultimately reveal itself in my view, over the longer term, a very substantial decline in the value of the dollar.
Felix, the 3.0 or plus CPI that you and Jeffrey both agree on, he mentions the New York Times. It does seem that there is a new unofficial mandate that I think during the Biden administration will become an official mandate of the Federal Reserve in America. And that's to seek unemployment levels for non-white Americans, Black and Hispanics, in the 3, maybe 4% range. So where historically unemployment might have been 6% and the Fed would make a U-turn. Instead, they're looking to be more involved in terms of social justice. Janet Yellen with a very similar program. I would think maybe Christine Lagarde, certainly Mario Draghi now that he's in charge in Italy. All of these central bankers are wearing a different cap now, Felix. They all want to be part of the solution to the social ills of the world, but could their prescriptions actually make the problems worse?
You know, the world's biggest problem over the last 10, 15 years has been not enough growth, because our system is built on growth. And if we do not have enough growth, we cannot serve all the liabilities that there are out there in the system. And therefore, whenever the growth declines to too low levels, authorities get concerned, and central bankers as well. We tried now for 10 years to create growth by printing money like crazy, QE, and it didn't really work very well for Main Street. It worked very well for Wall Street. And I think they have realized that creating money is one thing, but you have to spend it. And what Jeffrey just alluded to is really they are going wild in the fiscal stimulus that they are applying to the current situation. So I think the next couple of years, the new era is really huge fiscal stimulus, government expenditures combined with huge monetary stimulus. And this is a prescription for higher nominal growth and higher inflation rates, and probably lower productivity and lower prosperity for a lot of people. Because what it all does, I mean, the US is more excessive than others in this respect. And what it all does is it weakens the US currency dramatically. We have now started the fourth of the major declines of the US currency since Bretton Woods broke apart, since the end of the gold standard. And on average, those bear market declines lasted about 7 years. You can make the point that it started in 2017 or in 2020. Whatever that means, the next 3 to 4 years, you will have a lower dollar, and the dollar could easily decline by 25 or 30% from current levels over that time span, which creates inflation because foreign products you import, and the US is a huge net importer, the foreign products get more expensive.
So Felix, let me just follow up on that then. During this period of decline for the dollar, could it actually find itself vulnerable to being replaced as the world's currency, reserve currency? I'm not sure if the yuan is ready to take its place, or if, you know, maybe cryptocurrency, which I know may sound far-fetched, but certainly every single day it seems to gain more credibility with the established Wall Street. Would the dollar be vulnerable enough that it would lose its status as the world's reserve currency?
That is a slow process, and I think we have probably another 30 to 50 years to go until the dollar as a reserve currency is totally gone and replaced by another currency, which could be the yuan. The yuan is not the convertible free market currency, and therefore, as long as you have capital controls in China, it cannot replace the US dollar as a reserve currency. So this is a long-term trend. But keep in mind that all the authorities, central banks and fiscal authorities, are doing the same thing as the US, just not quite as excessively. Right. So the currencies are all losing value. You know, the Swiss franc has been the strongest currency in the last 100 years, and it had lost probably 86 or 87% of its purchasing power. You see? Right. So they are all going down the drain, and what it does is you really weaken the denominator of all the assets we are trading and talking about, and therefore they may make them appear going up in price, but it's because, to a large extent, it's because you weaken the denominator.
Jeffrey, on that note then, the United States, once this $1.9 trillion goes through, that will be all combined about 25% of GDP. You can say it's the most generous of all the countries in the world, but it also established a precedent that could be taken even further. A lot of talk about universal basic income and things like that. Where do you stand? I mean, as something of a purist, I would imagine, when it comes to economies and the way business cycles work, all of these things seem to conspire against just being able to use any sort of traditional modeling from where we go from here.
Well, I think that's right. You know, we've talked about all of these extraordinary policies, and I've been amazed over my career, which is now almost 40 years, at how creative these policymakers are. You think that they're completely out of tricks, and then they come up with more tricks. And now even Janet Yellen, who's Secretary of the Treasury, but obviously very tied into the Fed, is cheerleading for, you know, as big a stimulus as you can possibly imagine. So clearly, we're looking to, go to a direct money spending program through consumers, which is the universal basic income we've already embarked on. I mean, once the 1400 comes through with the $1.9 trillion package, that'll be $4,000 per person over the last 12 months. Andrew Yang ran a semi-successful Democratic nomination campaign on $12,000 a year, and people thought that it was novel and a little bit weird, and yet we're already 1/3 of the way to that program being implemented without even, really a plan underneath it, just on an ad hoc basis. Felix says as much as 50 years for the dollar to lose its reserve currency status completely. I'm going to take the under on that by a lot. I think that the estimates of how long things are going to take keep getting shortened. Remember, a couple decades ago, Social Security was supposed to be solvent until like 2060, and then it became 2040 and 2030, and now I think it's 2025. And also, China was supposed to have surpassed the United States in terms of GDP a few decades from now, and now that's being rolled back to, I think, 2028. It just seems to me that Felix is right. They have a problem with the non-convertibility of the currency, which makes it really just, that has to be changed if you're going to be a reserve currency. But I think that's their goal, and they can definitely make changes. It seems to me if you have the highest GDP and you have a building military, which China clearly is in the process of ramping up, well, maybe you will become the reserve currency. So I think we've been very blessed, United States, thanks to maybe not the nicest factors, like the military-industrial complex has created the biggest military in the history of mankind. But we're frittering it away. I mean, we've got these ridiculous policies in terms of deficit spending and now trade deficit increasing. One thing that's gone unnoticed is over the past year, the U.S. trade deficit has reversed course from a gradual narrowing, and it's increased tremendously by about 1.5% of GDP. Right. And that is also weighing heavily on the dollar. If you just look at a 50,000-foot overview, when we throw, a few $1 trillion at the United States consumer, it's not surprising that our trade deficit explodes, because we've got a lot of people that aren't producing anything. They're just spending. And not surprisingly, we've had a big explosion in our trade deficit with China, because if you give people money and they go out and buy stuff that says made in China on it with their stimulus money, well, you get retail sales, but you're not really getting economic domestic growth. And these are all factors that I think are incredibly important in asset allocation. And I've been recommending since the summer of 2020, very, very vociferously, that investors should be owning emerging market equities as opposed to developed and certainly US equities. And as the currency trend continues, that's just going to be reinforced with pockets of relative movement. So I still think it's early in that game. The United States stock market outperformed by so much over the last 10 years, by a factor of 3 times the rest of the world, 300% outperformance. And the amount of catch up that is likely to occur, it has just begun. So I think that we could easily see a 100% outperformance of emerging market basket, particularly Asian, versus the United States. Let's just call it the S&P 500. Right. And it's been working quite well. In fact, even year to date, there's a noticeable return differential in favor of emerging Asia.
Felix, I saw you nodding a lot, so I think you may have some thoughts and comments on that. And maybe also just add in with your thinking here as well, the populist movement on both sides of the Atlantic and the role that that has played in sort of pushing policy. Let's not forget, one wave of socialism brought us, the Social Security, which Bismarck saw as a way of maybe fending off the socialism movement, knowing, and of course America adopted it at the time, both sides of the Atlantic, knowing not many people were living to 65, but ultimately that became an issue as well. So you can piggyback off of what Jeffrey said, but if you can also add some comments on that as well.
Well, if we are right in that the dollar declines in coming years on a major trend basis, then I do believe that we have a powerful bull market in commodities. Not necessarily because we see huge infrastructure. I think infrastructure will be pushed by government expenditures clearly, and not just in the US. I think it's in all of the Western world and all in the emerging world, wherever they have the money. And this is positive for commodities, certainly for base metals. I also believe that climate change will probably work in the other direction than what is generally assumed as being the right topic. So I think the climate will at the margin turn a little bit cooler, and this leads to less good harvests and harvesting problems, etc. And this is very powerful bullish factor for the agricultural commodities. So I think you have a bull market in commodities, and the major producers of commodities are emerging economies, and therefore it makes a lot of sense to overweight emerging economies. I do not believe that these trends will be a straight line. I think there will be interruptions. And you know, the market's character has changed a lot. In the old days, and I'm in the market for 50 years now, in the old days, the market cycle was a smooth occurrence. It started out slowly and then accelerated, and then it slowed down and then it declined. In today's world, it is straight up and straight down. You have nothing in between. And it's because our system is so leveraged up that the authorities know that it's so fragile, they cannot let it slip away. And therefore, whenever the market goes down a lot, and the algorithms drive it down and everybody's on the same side, you have a big sell-off, but the authorities come in quickly to save the day. And you saw it usually at the bottom, like in March 2020. Usually you have a climax, a selling climax, you have a low, you bounce and you come back and retest and then you go. You don't have those retesting procedures anymore. This is gone, and it's gone because they bring on the heavy cannons, the heavy guns to really push markets up. And I think the downturn comes when everybody is positioned in the same way. We have a lot of excesses, and then something unexpected happens. And then you have a huge sell-off. It happens very quickly, and then it's over with. So I think the character of the markets has changed a lot, and the algorithms, the machines do that.
Well, on that note, I know, like, when it comes to the human body, they say if you get in a cycle of losing a lot of weight and then putting it back on, and then losing a lot of weight and then putting it back on, that there's structural damage to the body. That's why I don't like to lose a lot of weight. So, so if that is the case, with what you're describing, is there any lingering structural damage to the economies and markets because we no longer have that smooth, business cycle?
Well, I think what it does to the economy is it forces the authorities' hands very early, and they do not let the system clear. And they didn't let the system clear for a long time. And the end effect is that you carry with you more and more structural burdens and indebtedness and things like that. And therefore, you weaken our system structurally tremendously. And usually in such a situation, the logical outcome would be a deflationary collapse at some point of time. But that is a no-go for any politician because you won't get re-elected with a deflationary problem. And therefore, I think they try to push it further up and up and up. And the end effect will probably be not a deflationary collapse of the markets and the economy, but I think you change our system. You get the government more involved. The share of the government of our GDP continues to rise, and we are slipping much more into a command economy, a planning economy that is managed. And the bear side to this is that we have a structural bear market in individual freedom. And we have a structural bear market in broad-based prosperity for the average person. And therefore, you have a structural increase of ever more people falling on the burden of the government. Right. And that is what you call a trend into socialism. And I think President Biden is adopting the European model and leads us more and more into socialism. And that is not necessarily a bad thing for the markets as a whole, but it's a bad thing for the efficiency of an economic system. And that means lower productivity and lower prosperity in the long run.
And also, Jeffrey, it would be something of a shock to Americans. Listen, in college, everyone kind of says, oh, the socialism thing seems like it's working nicely. It seems fair, which is a popular word in America these days. We look at some of these European countries, particularly some of the Scandinavian countries, saying, golly, they've got it all. They live like we live with less stress. They live longer. And so what? They pay higher taxes. But is America truly prepared? Do you think, the America that kind of rose up from pulling itself up by the bootstraps to give up those freedoms? Because I think a lot of younger Americans think they're going to have it both ways, and I don't think that's going to be possible.
Yeah, I agree with you that that's not going to be the outcome. I think that what the planning type of authorities are hoping for is, that they would be able to tamp down some of the populism and some of the unhappiness and unrest. But the opposite has been happening. As we've been giving money away, we see riots all over the place and all kinds of trouble. So it's really, these types of experiments have been attempted quite a few times, even in the 20th century, with Yugoslavia and Hungary and the Weimar Republic, and more recently Venezuela. And you see just astronomical inflation rates that can develop in 1 or 2 years, very short time window, when these things really go full bore. So I really agree with Felix about a very positive commodity cycle. One of the charts that I've been using now for a few years, and I dust it off at least once a year for my webcast audiences, is the relative performance of the Dow Jones Industrial Average, so you can go back a long time, and a commodity index like the Goldman Sachs Commodity Index, just the total return performance. And the cycles are very repetitious, and they're extremely broad swings. You go from about an 8 times outperformance of commodities versus stocks, and then it gets reversed over a multi-year or decade time frame to an 800 or 900% underperformance. And we're right down, we were last summer, right down at the kind of historical extreme. So the amount of performance that's occurred so far, just like my comment on emerging markets, is just the beginning if we're in that type of a cycle. We talked about, Felix also talked about how the market isn't working smoothly and it goes straight down and straight up. I believe that event started to happen around 2018. You might remember in 2017, there was a lot of appropriate commentary about how the VIX index for the volatility on stocks was the most subdued in market record history. There were many, many days in 2017 the VIX closed below 10, which was a very rare phenomenon to ever happen, even a couple of days during a year. And it happened, I think, dozens of times in 2017. Then all of a sudden, it spiked up, and we've been elevated now above 20 on the VIX for a long time. I mean, it's basically a year now, and we just can't get below that, even though the stock market has been relatively calm in terms of its actual and volatility for the past, I don't know, I'll call it like 5 months now. We still can't get that down, and I believe that this is a long-term trend that will go to wider swings, big melt-ups, big meltdowns on a recurring basis. I'd be so bold as to predict that we'll see the VIX index sometime in the next year or 18 months go over 100, because there'll be that kind of volatility in the market. And there'll be, one thing that's helpful in the investment business that I've, maybe it's unique to me, but it's a characteristic that I've fortunately have, is I have sort of an emotional memory of how it feels when things really get dicey in markets, how, all confidence dissipates and you get into these wild swings of volatility. And if you can remember how it felt the end of March 2020, well, a little less than a year ago, people thought the world was coming to an end. And I think the next bout of volatility on the downside, it'll be yet another order of magnitude higher in terms of how people feel, because there really isn't a fundamental underneath our economic growth right now. The United States is not out of recession. The big economic downturn that occurred last spring has not been filled. I don't believe this arbitrary definition that if you get a couple quarters of positive growth, you're out of a recession. For me, and this is just my way of looking at economics, I don't think you're out of a recession until you go to a new high in real and nominal GDP growth. And we're not even close. to that.
Right.
So we don't really have growth right now. I mean, it's possible that at the end of 2021, thanks to another couple $1 trillion of stimulus, it's possible that we get nominal GDP back to first quarter of 2020 levels, but it's also quite possible we don't get there. So we're still in a recession. There's still all kinds of trouble. Why are all these Fed officials and Janet Yellen and even President Biden basically yelling from the rooftops that we need to go super big on stimulus? They must not think the economy's in very good shape, and that's where we're going to head. And yes, they have a social justice aspect to it, which I think makes it easier to pass these programs. And so it might be for sinister reasons that they go to pull certain levers on rationalizing their policies, which, as I said earlier, I mean, we're borrowing at 25% of GDP, numbers that we used to think 5% was uncomfortably high, and we're headed to infinity and beyond. And the Federal Reserve, Jay Powell, has said there's no limit to the enabling that the Federal Reserve is willing to contemplate in terms of lending money to fund the Treasury's deficits. And so that's the business model, if you want to call it that, and it's not working. So let's do twice as much, and it'll not work twice as badly, I'm afraid. So it's not a very optimistic outlook, but you have to play the cards you're dealt in this business.
Yeah, I mean, it definitely feels like whatever. Right? To your point, 10 years ago, everyone was sounding the alarm, but we didn't go off the cliff. And now no one's sounding the alarm. And it feels like wherever that cliff is, wherever that Felix, wherever that edge is, we will find it, because there won't be any sort of discipline by any of these entities to start trying to reverse their actions. I mean, to your point, they become actually hostage to these actions and have to go bigger and bigger every single time around. So. But something Jeff said, and I want to get your thoughts on this, about last year. Did you find it curious, though, about not necessarily the actions that were taken? And by the way, they were pretty swift, from the federal government side in America to the Federal Reserve, and also global, even around the world. But by investors themselves, particularly this new wave of individual investors who bought when all the experts were saying to sell.
Well, actually, the individual investor has been absent in the market for many, many years. From 2009 to beginning of 2020, the individual investor was actually not present, and he was a net seller of equities throughout all these years. And it changed in 2020. It probably has something to do with the home office, when people are at home and they have time to go to investment forums and chats, etc., and then all of a sudden it started, and it then feeds into what happened for the first time in history. I mean, I'm working in the markets for almost 50 years, and I have never seen, and this was one of the deepest declines and slumps in the economy, I have never seen a recession and at the same time personal income go to new highs, and obviously the money was out there and checks were sent out, etc. And the individuals, the retailers, they all of a sudden had extra money they did not expect, and they were spending time on the investment forums and got attracted and started to play like casinos. They started to play, and I think this is a phenomenon that you usually see very late in the cycle. So we had a bull market from 09 up to now, and after 10 years, the individual finally looks at the situation, and then he looks back and he says, okay, this is what I should have done. Why not doing it now? And so he's now in the game, and the individuals are roaringly bullish, and actually the professionals are also excessively bullish. Their long position, according to the recent global managers fund managers survey by Bank of America, they have the largest long exposure and the highest risk exposure in 20 years.
Right.
So you have everybody positioned for smooth sailing to the upside. And Jeffrey was talking about the VIX sticking at around 20. I would think that even next month we could see a doubling of the VIX for a shakeout before it continues. You know,
when you use the word casino, I think that's really appropriate, because I think that's actually there's something that I'm very anti-gambling. I don't understand why people do it in casinos, because it's just bizarre to me that people, to take a proposition where they're almost guaranteed to lose. But it has a lot to do with the psychology of it. And one of the things that makes gambling so insidious is when people go up, when they win a couple of hands or whatever, they start getting more reckless because they feel like they're playing with the house's money. It's not even their money they're losing, and so they're inclined to get more reckless and increase the odds that they lose it all. I think that's what's happening on an unintended consequences basis with this government stimulus, is that people are got $600 in December, and that's just found money. I think they feel like I've heard many stories about people saying, so what if I lose a lot of money on my 5 shares of GameStop? I only have 5 shares, and it's the government bought it for me. So what's the big deal? It's almost like a superior to a lottery ticket in terms of its risk reward profile, and so it leads to a gambling mentality. And as the stimulus checks come rolling in, I have a feeling that we're going to get more of that mentality happening again. So it's really an interesting situation, because by many valuation metrics, the U.S. stock market is about as highly valued as it's ever been. If you look at many metrics, it's in the top percentile of the last multiple decade time period. But what's fascinating about it is, until very recently, and it's still largely the case, but it was extreme back 3 months ago, as overvalued as equities look by these metrics, they're actually cheap to bonds by a historical kind of yield comparison. They're not even averagely priced. Bonds are so rich because of the government's action, and they were when the 10-year was below 1% in particular. They were so rich that even the PE of equities being at 1929 types of levels on a CAPE ratio basis, and second highest in history, it actually screens below average valuation versus treasury bonds. So the distortion that has happened with these policies of the Fed, suppressing interest rates, has found its way through this casino mentality of government money, through a chain of events that's led to these high valuations. That, though I don't really want to own the thing, I've got to believe that if money gets sent out in the next 6 weeks, $1,400 per person, I have a hard time believing that it's not going to find its way into further inflating this bullish fervor that's going on.
But watch out if something happens unexpected. We have all seen the charts of call option volume. It has gone parabolic. So yes. a lot of players have been playing the market by buying call options. If the market, for whatever reason, at some point this year, probably later this year, begins to decline, the market maker in the options who sells the calls to somebody has to hedge by going long the stocks. And at some point of time in the decline, he has to sell out completely. And that gives you those straight lines down. As we have straight lines up, all of a sudden we have straight lines down. So I think it's, as Jeffrey said, I think it's going to become much more volatile in the next few quarters.
Felix, and you both agree that the VIX is going to make a dramatic parabolic move relatively soon. But you also referenced the Bank of America survey with the global money managers. They were relatively bearish, very conservative throughout almost all of 2020. And now all of a sudden they're 63% long, the lowest cash amount that they've had in 8 years. And it kind of reminds me of the story of Sir Isaac Newton. One of the greatest bubbles in history, I think it was that Mississippi stock scam. All of his friends were making a lot of money on it. They would go to the parties, and he told every one of them, "You're going to lose it all. You're making a mistake." Finally, he said, "You know what? I'll give it a shot." And he lost it all. So the smartest man to ever grace the face of the earth was seduced eventually by the excitement. Is some of that going on in the professional circles right now?
I believe so, because you have to keep up with performance, and you have to be in the performance stocks. The pros have to be in the market, and they have to perform. If you do not perform for a certain period of time, you lose the mandate, and that's your business risk. And therefore, they have to catch up and stay with what's in the game and what's winning and what's hot. If they don't, they run the risk of losing businesses. And therefore, everybody eventually ends up in the same stocks and on the same side. And that's when something unexpected happens, because there is no marginal new buyer left. And then you go down.
One of the most incredible reversals that we've seen, maybe in years, happened just in the last few months. We had the mega cap stocks, you know, which of course be the Super Six, but primarily the FANGs and Microsoft, were outperforming by a huge amount. Mega caps were outperforming small caps massively. And that outperformance is completely reversed, totally, is completely reversed. And now mega caps have underperformed the smaller cap stocks for the past 4 to 5 years. That entire outperformance was reversed in just a few months. And I think that there's a lot of reversals that are going on. We've seen weak balance sheets start to outperform strong balance sheets. We've seen the emerging markets start to outperform the US. And I always think that whatever is the big leader into a very strong market, you got to watch out for when that leader starts to flag. It's kind of like they're leading on the upside, and I call them on the battlefield of the performance war, if you want to call it that, Felix. I call it, they're the generals. So you had these generals leading the charge, and the troops were kind of falling behind. But now the generals have left the field. And so one thing that I think is responsible for that, again, is all of this little guy trading through government money, because they love these little micro cap names. That's become incredibly popular. Penny stocks are now very popular. And as Felix alluded to, that type of behavior is very uncharacteristic of a buying opportunity and highly characteristic of very late cycle heading into mania. Charles, you mentioned the Mississippi scheme. There's a great book. I've read it a couple of times. It's an easy read. It's by John Kenneth Galbraith. It's called The Great Crash of 1929. And it just goes through the Florida land speculation of the early 1920s and how that set the stage for the ultimate speculation in the stock market and how everything went haywire in 1929. It's a very interesting read. I recommend it to everybody. It's a perspective that it's very interesting to think about where we are today when you read a book like that.
I've noted it and I can't wait to pick it up. So then let's go back. Let's talk about this relationship with the small investor. The FDM, I think that's the Goldman Sachs Microcap Index, is up in the last 8 months, something like 70%, followed by the Russell Russell 2000. There's going to be a hearing in Washington, D.C. About the whole GameStop saga. I think King Griffin will be there. Some of the role players on Reddit. And there's some speculation that maybe, just maybe, Felix, there could be something out of there that changes the rules of the game with the stock market, whether it curtails the ability to have more than 100% of a stock short, the role of options to take positions, particularly when there's sort of these complicated options maneuvers that allow extreme leverage. Should anything come out of this, what do you think is going to happen?
Well, usually they protect the big guys, always. They protect the banks, the bankers, and the very big guys, always. That's has been the rule of the regulators over time. And I expect something like that along those lines. The interesting thing was that in some stocks, there were shorts outstanding more than 100% of the outstanding shares. And I think that should not happen. You know, when that happens, you have a squeeze going on you can't really resolve. And I think that should be prevented by regulation. Other than that, I think there's nothing wrong with short selling. Short selling is fine. The problem is when you have a rigged market, when you have a stock sold short of a company that is making losses and is really doing bad, cyclically and structurally, and the stock goes down, and the pros short it and short more than there are outstanding stocks, and then an investment forum picks it up and creates a short squeeze. You know, I'm not sure whether that is legal or not, or whether it is already illegal. But if it would have been the other way around, that the small guys would have been squeezed by the big guys, there would no new regulation come up. I'm quite sure.
Right.
Yeah, I'm sure you're right. I just don't think these congressional hearing types of things, but they're just a reaction to make it look like we're talking about something or doing something. I agree that there should be some regulation about shorting more than the outstanding supply of stock, but I would expect very little to be done in response to an event now that is fading into the rearview mirror. I think it would take a much stronger event than that to actually get something to happen. But certainly, I wouldn't expect any sort of meaningful regulation to come out of these hearings at all. I remember when they called Mark Zuckerberg in front of Congress. It had to be like 3 or 4 years ago. And the congressman didn't even know what questions to ask. They just had no idea. I mean, they were shocked to hear Facebook was selling ads. They couldn't believe it. You know, so for these people to suddenly get insight and intelligence about some of the, you know, the leverage and the option buying and the like, it would take an awful lot of tutorials, I think, and I don't expect that's going to happen.
I admit I'm really nervous about hearing Maxine Waters try to get into the nuances of all of this. I think a lot of those folks are going to embarrass themselves, but it will be a public display for public consumption.
I remember when she was giving Jamie Dimon of JP Morgan a really hard time, and about student loans, about how they were punishing people with their student loans and they're ruining people's futures. And Jamie Dimon said to Maxine Waters, "Maxine, we haven't made a student loan in 10 years. You, the government, have been making all the student loans. You don't even know who's making the loans. You're berating Jamie Dimon for his evil behavior on student loans. He's not making any student loans." That's how ignorant these people who are on, you know, finance committees in Congress are. It's pretty horrifying. Maybe term limits would be the answer.
Maybe. Felix, when does the system get cleaned out? In other words, you know, we go from 5% borrowing to 25% to 50% to 100%, whatever the number is. It can't go on forever. There's got to be, you know, you talked about this new business cycle, these sharp moves to the up and down side, but at some point, do we need a sort of magnificent cleansing process? Do we need someone who's fearless at the Federal Reserve? You know, sort of the combination we had when Ronald Reagan was in office, a politician and a central banker, not afraid to be unpopular for a couple of years to clean out the system, if you will, so that we can get a real, true, fresh start.
Well, I think the backlash will be political, and I think what we have seen with Trump, who tried to put himself in front of a certain revolution against the political establishment, that was just a warm-up. I think it will get much worse in years to come, and at some point of time, I cannot predict when that will be, but at some point of time, the people out there, a majority, will get so angry with the political establishment that they are revolting, and then they go for change, and then it gets very nasty, and then we might have change, and it will not be nice going through that change and the chaotic situation that will be created. But that's usually what happens, whether it's country A or country B, doesn't matter. We will see something like that in Europe. We will see something like that in North America. In all the countries where prosperity for the average John and Jane goes down, you reach at some point that point where you get that backlash. And I think the Trump era was just a warm-up for that.
I agree.
Jeffrey, you talked about you know, your emotional attachments or how you felt emotionally during these massive pullback periods. You know, the pain is something it's just a big industry. We don't want to endure, and I say we, I mean citizens of the West, any kind of pain, whether it's physical pain, whether it's emotional pain, whether it's economic pain. We've got a pill for this, a pill for that. a doctor, a psychiatrist, something. We just have forgotten the notion of going through any kind of pain at all. And you know, there are times when it is inevitable. And so, you know, to Felix's point, what happens in that kind of a scenario?
Well, I just think that there's a lot of ways of addressing that question. I'll start from almost an investment perspective. You know, I believe there's a certain amount of risk in the world. There's a certain amount of risk inherent in markets and in life and in society. And where things go wrong is what you're alluding to, is when you try to rid the world of its inherent risk. So I use the example of hedge funds. Every now and then you get a hedge fund that has some idea, some sort of a gimmick, and they think that they can generate something like 1% per month every single month with no volatility. So they've created a system, they think, that has eliminated all the investment volatility from the system, and they're going to go on with this perfect, you know, infinite Sharpe ratio. And it actually can work for a while. Sometimes it's a fraud, like Bernie Madoff. Sometimes it's just a low volatility period. And you can actually get some of these ideas that work for, I don't know, maybe even 30 months in a row. And then all of a sudden, something happens. There's a shock to the system, and they report a -2 month. And then invariably, this happened to Bear Stearns, it happened to David Askin in the 90s. About 2 weeks later, they have to put out a revised performance report that they weren't down 2, they were actually down 20. And the reason was that they didn't believe the marks they were getting, their models didn't agree with them, but now they realized that the marks were -20. And then the investors all go ballistic because they can't believe that this 1% a month has turned into a -20% month, but they don't even know what's coming next, because 3 weeks after that, they get the bankruptcy letter that they're completely out of business. And I think that's an investment analogy for how society works. So you're right, we got a pill for everything. Nobody wants to take any pain. And we're going to have, you know, free things for everybody, and it's all good until such time as the -20 shows up. And then the -20 turns into what Felix is talking about through social upheaval. And I've been predicting that we will see a more than two-party system. I think 2024 will actually see more than a two-party system in the United States. We're already seeing buyer's remorse on a lot of these politicians. I mean, Gavin Newsom, we have now in California surpassed the 1.5 million signature threshold, and Gavin Newsom is going to be on the ballot for recall coming up. It'll be very interesting to see if California will vote for a Republican, if they're that disgusted with what's been going on with the Democratic leadership, because there's so many Democrats in California that it's almost mathematically impossible, it would seem, unless suddenly the scales fell from everybody's eyes simultaneously and they realize that these policies, I mean, I live in Southern California, and the living conditions have deteriorated so rapidly over the past 3 or 4 years. The homelessness, the trash, crime is off the charts, the freeways are falling apart, and people are sort of disgusted by this. Maybe a moment will come where suddenly everybody gets the idea that change is needed. I've been looking, because of all the censorship that's been going on social media and all of the canceling and everything that's going on. I took a moment earlier this week to review the McCarthy hearings back in the 1950s with Senator Joe McCarthy, and all the stuff that was going on with smearing people's reputations and essentially canceling people. And then there was that one moment at the congressional hearing when Joseph McCarthy he violated a pledge that he had made to one of the interrogating Congress people, that he wouldn't mention this guy's name that worked at the interrogator, I can't remember his name, his law firm. But Joe McCarthy got so irritated that this interrogator congressman was pushing too hard on his attorney, Roy Cohn, that he broke the promise and started to smear this guy that worked at this congressman's law firm. And in a beautifully eloquent and just historically powerful moment, this congressman just said, "Do you have no decency, sir? Have you no decency?" And Joseph McCarthy's career ended in that moment. You could just see he was speechless, literally, and he just realized he had pushed everything one bridge too far. And I'm hoping that we get a moment like that sometime in the next couple of years, because maybe that would accelerate the process of the reset and make it less potentially violent or painful, if we could compress it into a moment of
Right.
global awareness, if we want to call it that.
I've got 4 minutes, and if we could, Felix, I'll start with you. Just the most important thing we have not covered right now, and also, why do you keep doing this? You've mentioned you've been doing it for 50 years. I want to understand your passion for this, and maybe if it's contagious, because I think it's laudable. I applaud the success that you both have enjoyed. You don't have to do this. You still are, and you're still willing to teach others.
Well, once you get hooked, you can't get off. The world is so fascinating because what we are living through literally is new. It has never happened in this way. And I want to see how the story continues. I want to, I won't live up to 150, but I want to see how it continues and how it ends, etc., etc. I think what referring to the current situation, what's important maybe as a closing remark from my side is everybody believes this is an easy game because you have central banks that stay excessively easy and have said to stay and overstay it excessively long. You have fiscal authorities that stay excessively easy and have said they will continue to do it, etc., etc. And therefore, and the economy, as Jeffrey described, is only coming out of the lows and is beginning to recover and maybe accelerating later in the year, etc., etc. And everybody believes with no tightening by the monetary policy, there is impossible to be a market decline. And I just want to remind our listeners, our audience, that 87 was one of the biggest stock market declines, and it happened in a short period of time, 36 or 37% in a few weeks' time, and most of it in one day. And there was no monetary tightening by the central bank, and there was no recession. All what happened was a declining dollar, a weakening dollar. The dollar went down every day, and bond yields went up every day, and up to a point where it triggered some models to begin selling, and then portfolio insurance kicked in. And I think this time we have all the algorithm acrobats out there, the machines, and they will kick in. So sometimes when the top is here, and I guess this is sometimes from mid-year on this year to mid-year next year, sometime in that time window, we will have a nasty surprise on the downside. And if you get out quickly, because you have to probably get in quickly again, as I said, straight up and straight down.
Right. Jeffrey?
I'm looking at what I've been looking at, I've called it the chart of the year for 2020, is parsing the economy and the markets into sectors. And one of the most fascinating things that we revealed from this study is technology, however it's defined. These are kind of blurry distinctions sometimes, but the official definition of technology represents 6% of GDP. And the employment in the technology sector is 2% of all employment. Yet the market capitalization of technology at year end was 38% of the market cap of the US stock market, the S&P 500. This is so wildly out of sync, and it is the single best example of what wealth inequality looks like. And we've got to get that trend to get more in sync. The market capitalization has to get more in sync with employment and GDP shares. And until that happens, I think we're headed into on a collision course with this type of social unrest we've been dealing with.
The Bond King, Jeffrey Gundlach, and the legend himself, Felix Zulauf. Gentlemen, thank you both very much. I thoroughly enjoyed it, and I'm sure the audience did as well. And I hope we can do it again real soon.
Thank you, Charles.
Thank you very much, Charles. Thank you, Jeffrey. Thank you for joining.